Today, let's talk about another popular investment option besides real estate. Furthermore, I would venture to assert that this is the best, safest, and simplest long-term investment strategy available to the vast majority of people. Additionally, this investment strategy has some of the best returns available while requiring very little effort. No skill is required. What if I told you that this investment outperformed 98% of hedge funds and 99% of individual investors? Would that surprise you even more? And it only takes around 20 minutes of your time to complete this. And yes, the title of the video should have given you a hint as to what I'm talking about. So let's discuss what an index fund is, how it operates, and how you can set it up yourself in a matter of minutes to profit over the long term and perhaps someday become wealthy enough to buy a Lamborghini, a yacht, a private island, or whatever else you like. Hi there, I'm Fred, and welcome to our channel. If you're new, please subscribe and tap the notification bell to be updated for more upcoming videos like this. So let's get started. To start, let's define an index fund. An index fund is just a collection of investments in which you could invest your money and then hold a stake. Here is an instance. Think about if I owned 1,000 apartment complexes, each of which was worth $1,000. I approach you and offer to sell you one of my structures for $1,000. That would be similar to going to a single company's website and purchasing one share of stock. However, the issue is that you currently only have one apartment complex or investment. And if the investment doesn't perform well, what happens? Perhaps the CEO of that one business you invested in loves to tweet, and as a result, he says some foolish things that land him in hot water with the SEC, and the business struggles in the short term. How can something like this be avoided? Well, here's how to fix this. Think about the scenario I gave you in my previous example, where instead of investing $1,000 and purchasing one of my 0 apartment buildings, you could invest $1,000 and receive 0% of everything I own. You, therefore, own a tiny portion of each of my apartment complexes. You receive an average return based on everything I own in this manner. In essence, this is an index fund. For only about $260, you could, for instance, own all 500 of the largest publicly traded companies in the country. By doing it this way, you buy practically every stock in every company, rather than just one. Additionally, you can do this with almost any market by using index funds. For the low price of just $28, you can acquire a small stake in practically every single international stock available. Or for the low cost of just $70, you can own a small portion of the entire US stock market. And it doesn't end there, because there are index funds available for almost every single market in existence. If you want to purchase a large number of properties but don't want to purchase just one REIT, V&Q provides all of this in addition to a large number of office buildings and hotels. When you start doing this, your money eventually goes a very long way. The fact that index funds charge very little in fees is their main benefit. This is because creating these indexes is very straightforward. They are very easy to control. There isn't much overhead, and you, the investor, benefit from all of the savings. And this is a fund that is passively managed. You can invest as little as 0.3% to 0.4% yearly in an entire portfolio of stocks that is automatically balanced and adjusted over time without any work on your part. That is utterly opposed to what is referred to as a mutual fund. And this fund uses expert stock pickers to buy and sell stocks over time to outperform the market average. However, all of the additional overhead costs and fees incurred as a result of doing this are ultimately passed on to you as the investor in the form of much higher fees. And none of that comes with any assurance that one will initially outperform the market. Speaking of that, only 22% of actively traded funds have outperformed the market over 10 years when performance for both index funds and mutual funds are compared. Only 22% succeeded in getting that outcome. Thus, investing in an index fund for 10 years would have been more profitable in 78% of cases, making you better off. The second benefit of doing this is that, for the majority of investors, investing in an index fund will be more profitable than investing directly in individual stocks. According to several studies, between 92 and 95% of portfolio managers were unable to outperform the market index over 15 years. And keep in mind that even these experts, who are among the brightest in their field, attended Ivy League universities and have profound knowledge of economics and finance and work in the field full-time every day, are unable to outperform the market index alone. And for the typical individual investor, those numbers are significantly worse. That is large because many investors trade emotionally and become panicked when the market falls. As a result, they try to time the market or buy stocks when they are rising out of fear of missing out. Returns are typically much lower than average as a result of this. Warren Buffett even stated in an interview in 2017 that 99% of people making the mistake of trying to predict when to buy and sell stocks. Warren Buffett even challenged a group of hedge fund managers to a $1 million wager that they couldn't outperform an index fund and the market over 10 years. For a $1 million wager, a standard Vanguard index fund outperformed the world's top hedge fund managers. And if the richest person alive at the moment is advising us to all go buy index funds, then I have a feeling that this advice we should probably pay attention to. The third benefit of investing in index funds is the extreme diversification they provide. For instance, even if your stock portfolio contains 20 different stocks, you could still lose a significant amount of money if one of them fails. On the other hand, the S&P 500 index fund contains 500 different stocks and businesses waiting for your overall return. And even if one of those doesn't work, you still have 499 others to support you, so it doesn't matter. Because you're betting long-term that the market will grow as a whole, the short-term performance of a few particular companies won't have an impact on your overall return. Additionally, doing this will greatly increase market stability for you as an investor. Because let's face it, most people are unable to handle market volatility. They panic and sell their investments as soon as they notice a decline. Once they notice that it is rising again, they decide to invest once more because it is currently rising. They also don't want to lose out on the money in its entirety. They are unable to cope with any kind of market volatility. An index fund would therefore resolve the majority of those problems simply by acknowledging the human propensity to panic and become emotionally charged over the smallest things. Fourth, index funds are quick and simple to set up. I simply adore how straightforward it is. So rather than taking risk, I'll just invest in the market as a whole, sit back, unwind, and concentrate my efforts on other things that will increase my income so that I can keep investing in the markets. And I'll even go so far as to say that most of those watching would be better off simply investing in an index fund to obtain the highest long-term average return. I must add that it is significantly less stressful to do this. Simply put, the attitude is one of buy it and forget about it. There is no frantic nighttime worrying about, say, upcoming earnings reports. There are no concerns about things like SEC allegations, businesses failing, or declining profits. No worries at all. Since index funds are my second largest investment after real estate, I don't worry about the market's long-term overall trending upward. Okay, before we talk about how you should proceed to invest and what are the best Vanguard index funds you should buy, please give a thumbs up if you're enjoying this video so far. And also, watch until the end to know which investment vehicle is the best for you. Also, do you want your comments to be highlighted? Try our super thanks, and your comments will be highlighted in this video, or join our membership program. Now, let's get back to the topic. The 3-fund portfolio is now my preferred method for investing in index funds. This is one of the most common index fund investment strategies, and over 10 years, it outperforms individual investors by 98%, as I already mentioned. Additionally, it consists of 3 funds, as the name would imply. Obviously, a US stock market index makes up the first fund. An international stock market index makes up fund number 2. The third fund is an index of the bond market. In comparison to almost anything else you could do on your own, this offers you the widest diversification at the lowest possible cost and will yield the highest overall returns. Additionally, because you are investing in various asset classes, you're also placing your money in 3 essentially uncorrelated markets. In this manner, if something were to happen to one, you would have 2 others to make up for it. So how simple is it to do this? Here are 3 Vanguard funds that in essence make up the entire portfolio. The Vanguard Total Stock Market Index Fund, also known as VT-SAX, is your first option for the US stock market. Then there is the VTIAX or Vanguard Total International Index Fund, which invests in international stocks. The Vanguard Total Bond Market Index Fund, also known as VBTLX, is an option for bonds. How much to buy and what to buy depends a lot on how close you are to retirement. When it comes to this, the general rule of thumb is that you can be more aggressive with your portfolio the further away you are from retirement, which indicates that the closer you are to retirement, the less aggressive your portfolio should be. The lower the level of risk you should take and the greater the need for bonds. This means that if you're in your 20s or 30s and similar to me, you probably wouldn't mind investing 70 to 90% of your portfolio in stocks and 10 to 30% in bonds. Then, just buy it and hold it for 30 to 40 years because you know that it will increase in value over the long term. That also gives you the best chance to bounce back from any sort of market downturn in the short term. Additionally, if you still have a few years before retirement, it might be a good idea to invest between 80% and 85% of your portfolio in bonds and the remaining 20% to 15% in stocks. In retirement, when you need the money, you will have a much safer, more stable return as a result. And as I've already mentioned, for the majority of people, this would have the best long-term average returns of pretty much anything you can do for yourself in the stock market. As a result, I won't get comments like, "This is bad advice because I bought Amazon 15 years ago and it's now worth $10 million, etc." This is extremely poor advice. Simply put, I've been talking for a very long time. I'm not referring to the select few who had exceptional stock luck or the 1% who were able to do this over the long term with success. I'm speaking to the vast majority of those who are currently watching this. I continue to invest in index funds, although real estate has been the most popular investment over the past 10 years because I fully understand the advantages, diversification, and stability of doing so over the long term for a relatively low cost. So what about the timing of the market though? Does the fact that we're getting close to new record highs indicate that now is a bad time to invest or a good time to do so? The fact is that no one can reliably and accurately forecast what will happen to the market soon. Consequently, it can be concluded that from the dozens, if not hundreds, of studies that have been conducted on the subject that time in the market consistently outperforms market timing. According to Charles Schwab's study, you're better off investing right away and holding for 20 years in 74% of cases. After that, you try to ride a wave while the market is at its lowest point. Why even try to forecast what the market will look like in the near future? Instead, I just invest whenever I have the cash with the hope of keeping it for a decade or more and making money. To carry out this task, all you need to do is visit Vanguard.com, open an account, and enter the details of your checking account. After that, you'll be ready to go in about 20 minutes. After that, all you have to do is keep investing in the same securities over and over again and anticipate seeing your wealth increase at the same rate as the stock market. You are welcome to use any other brokerages that are available. Fidelity is yet another excellent illustration. All you have to do is that it's very simple, and at a very low cost, that strategy will outperform 99% of available individual investors. Nothing about this isn't appealing. Thanks for watching. Please subscribe, like, and share this video. And if you're serious about investing in index funds, then find out the best index funds by watching this video. So click and watch the next video here.